If you want to learn how to create a direct method cash flow, then this video is perfect for you. We will discuss a few theories behind this method, and more importantly, I will show you how everything is prepared in practice. You are watching Accounting Zero to Hero. As I mentioned, this video will teach you how to create cash flows under the direct method of IAS 7. This type of preparation is perfect when you are required to use the direct method, and at the same time, the company is maintaining a few bank accounts with transactions, preferably in Excel, that you can scrutinize without taking too much time. You will see why these conditions are necessary for this approach to work in our discussions later. If you missed our first 3 videos in this series, you could visit them through the links in the description. The videos in this cash flow series will be shown in the following structure. First, we discussed the theoretical basis of the cash flow preparation in part 1. And then after the theoretical basis, we moved on to the practical applications. Part 2 and Part 3 are all related to the indirect method, with Part 2 discussing the traditional way of preparing the indirect method cash flows, and Part 3 discussing how to do it using the cash flow worksheet. And now, Parts 4 and 5 will discuss the direct method cash flows, with this video focusing on how to do it manually. In the next video, we will discuss how to use the worksheet method and applying it to the direct method approach. This way, you can have more options depending on what type of information is available to you. Let us formally start the discussion with a recap of the direct method. We are doing this again in case you did not yet watch part 1 of the series, which discussed the cash flow theories. However, if you already know this and you are only interested in the actual cash flow preparation, you can skip to that part through the timestamps in the description. Under the direct method, the major classes of gross cash receipts and gross cash payments can be obtained from 2 ways. Number 1, you can use the accounting records of the entity by analyzing the cash book and our bank statements. And number 2, by adjusting sales, cost of sales, and other items recognized in the profit or loss for changes during the period in inventories and operating receivables and payables, other non-cash items, and other items for which the cash effects are investing or financing cash flows. This text is lifted directly from the standard, and you will eventually notice that the 2 methods here are exactly the 2 methods that we will be discussing in practice. The direct method using the manual approach, which is letter A, using the accounting records of the entity, and the direct method by adjusting sales, cost of sales, and other items recognized in profit or loss, which is practically what we will do using the worksheet approach in the next video. Below shows an example of a cash flow statement prepared using the direct method. It shows gross cash receipts and gross cash payments in the operating activities section. In the indirect method, we started with profit or loss before after tax and made some adjustments in order to arrive to the operating activities section. You have to know that in the indirect method, the valuable information is in the ending balance, the net cash from operating activities, because all of the information to arrive to the net cash from operating activities does not give you gross cash receipts and gross cash payments. You have no idea how cash was actually spent in the business. And that is actually cured by the direct method, because here you know how much cash was received from customers, how much cash was paid to suppliers, and how much cash was paid to employees, and so on and so forth. IAS 7 encourages the use of the direct method because of this purpose. It's easier to understand. However, in practice, you have to know that the indirect method is more common because it's easier to prepare. Later, we will be comparing the cash flows from the direct method exercise to the cash flows from the previous videos in the indirect method so that you can see the difference. One of the reasons IAS 7 prefers the direct method is because it provides an easier way to forecast future cash flows if you can see the periodic growth of gross cash receipts and gross cash payments, compared to the overall information or the general information that you can obtain from the indirect method. Let's now move into the heart of the discussion. All the cash flow examples that we will discuss will be coming from a single dataset that we have prepared. This is to emphasize how all of these ways of preparing the cash flows will result in the same cash flow data in the end. We will be working with 3 particular tabs. The first one shows the balance sheet of AZH Company Limited for 20x2, which is the current year, and 20x1, which is the previous year. We also have the income statement of the company for the current year, and some additional relevant information about the current year transactions. In particular, a piece of land costing $25,000 was sold for $35,000 in cash, resulting to a $10,000 gain. Plant assets or property, plant, and equipment costing $50,000 was purchased by issuing a long-term notes payable, meaning it was not paid in cash. A portion of this notes payable were paid before year end. AZH Company borrowed an additional $100,000 from the bank. Dividends of $218,000 were paid to shareholders. The company issued $5,000 worth of common stock for cash during the year. And lastly, the associate or investment in associate that we see in the balance sheet is 30% owned. During the current year, it generated profits of $100,000 and declared total dividends of $50,000. The second tab shows the general ledger of the company during the year. In particular, it shows all of the journal entries from January up to the last journal entry entered by the company in December of the current year. And lastly, the last tab shows the cash book or the bank statement of the company during the year. As a way of checking, the beginning balance of $255,000 and the ending balance of $350,000 agrees to the cash balance in the balance sheet that we have shown previously. All of these videos will be using these data in varying amounts depending on what type of cash flow preparation we have chosen. This means that these three tabs may not entirely be relevant for a particular problem. To obtain this specific file, you may email us at contact@accountingzerotohero.com. Otherwise, you may follow the discussion and apply the concepts to the specific problem that you are currently working on. Let's go! What makes the direct method cash flow unique, specifically this type of preparation, the manual approach, is that we're going to take the literal meaning of the cash flows, being the movements in cash for the period for a particular entity. To achieve that, we are going to have to follow a few steps. Number one, always prepare the cash flow format that you will be using. Here, we will use a format that is consistent with the standard, which is IAS 7. The operating cash flows classification are listed above here. The investing activities are listed in the middle, and the financing activities are listed in the last part. We have formulas for totals as well for the three activities, and formula for the net cash movement, which is the total of the operating, investing, and financing activity. We have a blank space for the beginning cash balance, which we will link later to the balance sheet, and the formula for the ending cash balance, which is the net cash movement plus the beginning cash balance. In the format as well, it's important that you include the checks. Here we will be comparing the cash in the balance sheet, which is right now blank, but we will link it later, to the ending cash balance of the cash flows. All of the lines here are temporary, especially if you are starting from scratch. You have to determine later if you need additional rows or additional classifications for cash flows for each activity. That is step 1. Step 2 is to obtain the cash book or the bank statement. For this particular problem, the cash book is in the third tab right here. The cash book is typically a subsidiary ledger where you will find all of the bank transactions during the year. The details include the dates, which is here, the amounts of the transactions, and transaction details that will help you later to classify all of these rows into cash flow activities. If ever the cash book is not available, you can use the bank statement as well. And if it's still not available, you can even use the general ledger, which is right here, by filtering all of the cash transactions in the debits and credits of the journal entries. Right now, the easiest way for us is to use the cash book since it is already here. You should be able to understand what is inside a subsidiary ledger. For here, it is presented as a debit credit, which means that if there is a debit, cash was increased or cash was received. And if there is a credit, it means that cash was paid or cash was disbursed. You also have to take note that sometimes you don't have just one bank statement. Some companies maintain more than one bank account, and in that case, you have to obtain all of the bank accounts that will reconcile to the ending cash balance in your balance sheet right here. For us, it is 350,000. Back to the cash book, because step 3 is about the cash book. The next step is to reconcile the cash book. Before doing anything, make sure that the data you have in the cash book or the bank statement is complete. There are a few things that I check first. Number 1, check the beginning balance of the cash book or bank statement if it agrees to the ending balance of last year. In this case, we have 255,000 of beginning balance in January 1, 20x2. Let us go to the problem. Here, in 20x1, the ending balance of cash is 255,000, which is exactly the same as the beginning balance in our cash book. Next, you have to check the formula if the ending balance is being computed properly, and all the debits credits are also being computed through formula so that you don't have any mathematical errors. Once you have determined the mathematical accuracy of your spreadsheet, you have to check if the ending balance is reconciling to the ending balance of your balance sheet. So here we have 350,000 of ending balance of cash, which is coming from the 255,000 of beginning balance, plus all of the transactions during the year. It sums up to a 350,000 ending balance in cash, which now agrees to the 350,000 that we have in the balance sheet. However, you have to take note that in actual practice is not always this perfect. You might have some reconciling differences coming from bank or book reconciling items, which can be learned if you know how to do bank reconciliation. This will not be discussed in this particular video. Once you are comfortable that the cash book is complete and you have all the details that you need to complete the cash flow, we can proceed to the fourth step. The fourth step is the more exciting part or more analytical part of the cash flow preparation using this method, the manual direct method. What we have to do is to classify each and every row of the cash movements in our cash book or bank statement as to the different type of activity. For here, you have to rely on your knowledge of the theories. If you don't know yet the theory, you can watch the first video of the series on the cash flow theories, where we discuss in detail what is included in operating activities, investing activities, and financing activities. As a recap, operating activities are cash flows from revenue-producing activities of the entity. So here, we're going to include some description. I am including this here so that you can have some sort of a checklist when trying to analyze the different movements later. So first, the operating activity. It is the revenue-producing activities of the entity. It can be sales, or payables, or payments of employees, or payments of advertising expenses, etc., etc. Investing activities are related to acquisition and disposal of long-term assets and other investments not included in cash and cash equivalents. For this purpose, I'm just going to include acquisition and disposal of long-term assets. And for financing activities, as a recap, these are activities that result in changes in the size and composition of the contributed equity and borrowings of the entity. So this one is related to the operating. This is the investing. And this is the financing. we will go through each and every row to determine whether they are related to the definitions of an operating, investing, and financing activity. You also have to take note that if you are confused and if it does not fall into investing or financing, then the standard says that it will be under operating activity. Let's go through step 4 now. First is the collection of accounts receivable. So this is related to a revenue producing activity since we are collecting the amount of sales that we already had in the past from customers. So I'm just going to include a green color here to signify that this is related to the operating activity. And it is not related to investing and financing activities. An additional bank loan. It is a debit because we have received cash from the bank. And this is related to borrowings. Now, borrowings is a function of financing activities. So it's not related to operating or investing because investing is only related to long-term assets and this is a liability. Dividends received from associate. We received 15,000 of dividends from our associate. Now you have to think about what type of asset is the associate. It is not a revenue producing activity because these are not sales and these are not related to equity and borrowings. So what you're left here is the investing activity, and more particularly, it is an investment. It is a long-term asset. Dividends received from associate, we received 15,000 debit, which means that our investment in associate declared dividends in the amount of 15,000 and we received it in our bank account. From the name itself, it is an investment in associate. So it is a long-term asset of the company. So it falls under the investing activity. The sale of land. Land is a long-term asset by default. Unless the company is involved in the buying and selling of land, then it becomes an inventory. But now we assume that the land that we sold is a long-term asset. So again, it becomes an investing activity. Additional issue of common stock. This means that subscribed capital or contributed equity was issued additionally to shareholders and we received 5,000. And from the definition itself, it is a financing activity because it is an increase in contributed capital. Payment of notes payable is also a financing activity because it is related to borrowings. Payment of dividends is also related to contributed equity. So it falls under financing activity. Payment of other operating expenses. It is a credit of 33,000 and we paid different suppliers. From the name itself, operating expenses, it is related to the revenue producing activities of the entity because without these operating expenses, we will not be able to generate sales to the customers. So this is an operating activity. Collection of accounts receivable again. This is just the same as the first row. So we received cash from the customers, so it is going to be an operating activity. Payment of an accounts payable. So this can be a bit confusing because it is related to a payable. However, the financing activity section is only related to long-term payable or long-term financing. Accounts payable or short-term payables are normally assumed to be operating activities. Payment of salaries, as we discussed, is an operating activity because we cannot generate sales, we cannot generate revenue if we are not paying our employees. Same as the payment of rent, we cannot generate income if we are not paying rent. So it is an operating activity. The payment of interest payable can actually be classified between financing and operating activities. So according to the standard, you can choose between the two as long as there is consistency year after year. So now we are going to assume that it's an operating activity based on the choice that we are making right now. as well as tax payable, this is an operating activity. You see, we are done with step 4. By going through the different activities and knowing the definition, you will be able to classify all of the cash movements of the company into the particular type. It is very important for you to know the theories because you will not be able to classify them properly if you are not aware of what is an operating, investing, or financing activity. You also have to take note that bank statements can be very, very long. There can be a lot of transactions during the year. That's why this type of cash flow preparation is only practical if you are able to scrutinize the transactions in the most efficient way possible. If you have thousands of pages of bank statement, then this might not be the best method for you. I'm just going to input here a conclusion so that it is clear later what is the activity that we have classified this cash flow for. So here it's an operating activity. This one is a financing. Now that we have done the summary, the next part of step 4 is to assign more specific descriptions of the cash flow under each activity, because you cannot just say that it's an operating activity. You have to classify what type of operating activity it is. Here, we have copy-pasted the whole cash book in the right side of the screen, and we are also going to include the conclusions that we had for each activity so that it is easier for us to choose. In the collection of accounts receivable, you can see and choose what type of subcategory it will be under operating activities. And typically, it would be cash receipts from customers, which is very obvious because we have received them from customers. For additional bank loan, it is a financing activity. So let's see. Proceeds from additional bank borrowings. So just copy, paste here like this. Dividends received from associate is an investing activity, which is already here. Sale of land, an investing activity, here, proceeds from sale of land. Additional issue of common stock, it is a financing activity, so proceeds from issue of common stock. Just copy paste them in the next section. So this is the subcategory. Payment of notes payable is a financing activity, so repayment of notes payable. Payment of dividends is a financing activity, so we choose under the financing activity, dividends declared and paid. Payment of other operating expenses, cash paid. For the payment of other operating expenses, we can choose under the operating activities, this particular cash paid for other operating expenses. For the collection of accounts receivable, we can still use the cash receipts from customers. Payment of accounts payable normally can be classified as cash paid to suppliers. For the payment of salaries, we can get cash paid to employees. For the payment of rent, since we do not have specific cash flows for the payment of rent, we are choosing not to add a row, but we can classify it under cash paid for other operating expenses because it is an operating expense. Payment for interest payable, so we can choose interest paid during the year, and income taxes paid is the payment of tax payable movement. Now that you have classified each and every cash flow movement into the subcategories, we can now proceed to step 5. Step 5 is the easiest step as long as you know the sum if formula. All you have to do is to link the cash flow template that you have done in step 1 to the cash book with the particular subcategory taggings. So you have to choose a formula that will pick up all of these movements here based on the categories. And the best one to use right now is the sum if formula. Sum if. So Excel will look into this range of text, look for this particular text, and if they find it, they will add the particular equivalent on the left. So right now, it's better to fix some amounts, some table references. Just to let you know, I put here all of these dollar signs to fix the references so that even if we copy the formula down, the reference will not move. So here, all you have to do is to copy the formula on all the lines that we are looking for. So you see that we have a total movement of 95,000 after copying all of the sum if formulas. You can already check if the total is correct by summing up all of the movements. So all of the total here sums up to 95,000. We still have a difference because we did not add the beginning cash balance. The beginning cash balance is equal to 255 from the balance sheet, and we now have an ending cash balance of 350. We now have to check if that is equal to the ending cash balance in the balance sheet, which is now okay. You see, it is easy to do it if you have a very short and straightforward cash book. It becomes more challenging as you have more data that you are looking at. We are now in the part of the video wherein we compare the differences between the indirect method and the direct method cash flow we prepared just now. In this tab, this is the direct method cash flow that we just completed. In the next tab is the indirect cash flow that we completed in the previous videos. If we're going to put them side by side, you will see that there is actually no difference in the financing activity and the investing activity sections. They are both 50,000 and 133,000 respectively. This is actually in accordance with the standard because this direct method and the indirect method cash flow are actually only applicable to the operating activities. However, you also have to notice that in the operating activity section, even though they are different in the way that they were presented or how to arrive at the ending balance of the operating activities, they are actually the same amount in the end. Right now, we're looking at 178,000 total of cash flow from operating activities in the direct method. In the indirect method, it is exactly the same amount. However, we have arrived to it using a different approach in the indirect method. You will also see that in the direct method, it is easier to understand. We know that the 178,000 came from receipts from customers of 541,000. We paid the suppliers, we paid the employees, operating expenses, and we paid interest and taxes. However, for the indirect method, it is not very clear where the cash came from. However, as I have said, in actual practice, it is actually easier to present the indirect method because we actually do not have much information about the bank statements or the cash books of the company, especially if the company becomes bigger and bigger. You cannot do this type of analysis on a 1,000-line bank statement, for example. And that's it actually for the video. I hope you found this super helpful. Remember that you can use this approach when the cash transactions are few and can be analyzed without spending too much time and effort on it. You can also use this if you're doing cash flows on a small business. If you have a big company with multiple bank accounts and thousands of transactions and you need to present using the direct method, I recommend using the worksheet approach that we will discuss in the next video. See you!